Hello and welcome to C-Suite Secrets. I'm Heather Parsons, your host, a serial entrepreneur, fractional CFO, and a business strategist. I've spent years juggling business and family life while helping entrepreneurs scale, optimize their cash flow, and build real financial success. On our show, we bring you real conversations with founders, executives, and operators who actually move the needle in business. No fluff, no filler, just smart strategy, systems that work, and insights that you can put to use in your business right away. With that, let's dive right in. Today on our show, we have Jason Fishman. Jason, welcome.
Thanks, Heather. Honor to be here.
Glad to have you. I'm really looking forward to our conversation. For folks who may not know you yet, can you tell us a little bit about your journey as an entrepreneur and what you all do?
Absolutely. I work with founders towards their growth. I've created an investor and user acquisition agency. We're best known for our investor marketing campaigns, where we've worked on over 500 deals that have collectively produced 9 figures of capital. And through digital media, through content, through advertising, through outreach, expanding upon a founder, a CEO's network to be able to reach more investors, take them through digital systems, and effectively raise capital.
I love it. I find this really interesting. I know you and I had some conversations in the past. I find it an interesting niche on how to do marketing. So, how did you realize that investor acquisition was really a marketing challenge, not just a fundraising problem?
Sure. I didn't necessarily study investment crowdfunding and Reg D, Reg CF, all these different exemptions in school. I'm a marketer. I was running a mobile advertising network, working with a lot of Fortune 500 type companies on these major ad campaigns. I started an agency being part of the Los Angeles startup ecosystem here and working with growth stage companies. I found fundraising to be a common theme in the discussions. Hey, we're looking to raise more capital. Can we run a first marketing campaign with you, present the results to our finance partner, and look to scale from there? Can you work on the marketing section of our business plan, our pitch deck? Can you actually participate in this investor meeting with us? This was a regular part of my day to field these questions, to work on some of these assignments. And at that point, I was introduced to Regulation D 506C, which allows for solicitation of accredited investors, high net worth, high household income audiences. And with my advertising background, I said, hey, I have data partners where I can run ads specifically to those individuals. You can be very focused on who you're reaching with ads, and there's a lot more data available to you than direct outreach. The first campaign was for a solar company. It hit $2.83 million with a very light ad spend. And we started getting introduced to more and more issuers, companies issuing shares, issuing offerings from there. Later, about a year or two down the line, Reg CF, regulation crowdfunding, went into law. And it was May of 2016, 10 years now. I don't know how the time has flown by. But that allows us to target retail investors as well, and any adult. So small investments, relatively speaking, $1,000, $2,000 average investment. Many of the minimums are $100, $500. But in volume, it really adds up. There's another filing we work on, Regulation A+. Reg CF, you could raise up to $5 million today. Regulation A+, you could raise up to $75 million. So much larger companies use this exemption. Some of them, while in path to go public. They'll use a Regulation A+ campaign to direct list. Much more in-depth filing process, more work on the administrative side, of course. That being said, some of the Regulation A+ issuers that we've worked with, they have tens of thousands of investors. One of them over 57,000 investors. So as you can imagine, they're getting more than just the capital. Every time they put out an update or announcement, they have shareholders repurposing, putting it out to their social media audiences, their email audiences, their local communities and in-person groups and friends and family. So I've seen this to be, a marketing exercise, not just to be successful in the raise, but the utility of the campaign format itself. So as I saw the impact, I just leaned further and further in, became more integrated into the ecosystem. I serve as the vice president of the Crowdfunding Professional Association and other boards, but because of the value this has for companies. I mean, many fail because they're undercapitalized. They're no longer limited to their first degree network, they can use this technology to be able to reach far more people, raise more, and get a lot more awareness, much more of an audience along the way.
I love it. And this is, correct me if I'm wrong here, this is just one seat on your cap table. You're not trying to
Correct.
manage these, you know, hundreds or thousands of investors individually. This is just one seat. And
It's
they're not somebody
structured.
who necessarily has control in your company. They just have a financial investment.
That's exactly correct. A misconception from folks who are not familiar with the space in many cases of, wow, thousands of investors. Sounds like a lot of calls, a lot of meetings, a lot of people slowing us down. Not the case at all. You are looked at to do annual reporting. Many issuers hold monthly, quarterly, half-year webinars and in-person events to provide updates on top of emails from there. But yes, they predominantly structured so that all the investors are on one seat of the cap table.
I love that, and from the perspective of, managing a business and managing these relationships, you should be doing those calls anyway. If you're not, shame on you. You're not taking care of your investors. You need to do it, right? Because
Yep.
they have given you their hard earned money and you have a fiduciary responsibility to show up for them. So I love that it's one seat. I find this super interesting. So as folks are trying to use this investment tool, what were they missing before they started working with you from a marketing perspective and finding people who were interested in their deal?
I'll use that word misconception again. I'm a numbers guy. I'm referencing the data constantly. There's actually a website called kingscrowd.com. You can look at all the Reg CF, Regulation A Plus campaigns to date. It has some information on the Reg D offerings as well. They put out annual stats. In 2025, the average investment on a Reg CF campaign was $1,716, meaning every 1,000 investments you get is about $1.7 million. Many issuers, I find, don't have any type of plan on how they're going to get that traffic to the offering page. If they're getting a 1%, 2% conversion rate online, if you're getting a 2% conversion rate, for most initiatives, you're in a good place, especially for this type of retail investment. So you may need 50,000, 100,000 visits to your offering page for that 1.7. And you can use that as a benchmark to look at lower and higher amounts, of course. But there's no answer to where that traffic's going to come from. We're going to send out some emails, people are going to talk about us, but you have to see the traffic coming through. And most importantly, it has to be converting. The transaction on the page, they have to put in some personal information, they have to put in their financial information, that has to be happening. But you could find starting points towards advertising or other traffic sources, see it working, and then scale from there. Many groups do rolling closes, take disbursements of the capital, reinvest portions of it back into marketing and spending with publishers or with agencies or whomever to get more traffic from the right investors there. So I would say that's probably the biggest misconception, is that they're not structured to drive enough traffic, and they don't really have a content marketing funnel. They're not putting out the social media posts. They don't have the right email drip system. They don't have enough publishers talking about them and different appearances at conferences or on podcasts or, wherever, to keep the audience excited, because it's not the first touch point that they invest. Another thing that many founders, CEOs are surprised by in many cases is that, it may be a few weeks, a few months after that first visit that they convert. It could come into effect when they're evaluating marketing channels and how they're getting investors there. It could be somewhat of a journey before someone moves forward. So enough traffic at a high enough conversion rate, using a sophisticated enough and engaging enough content marketing funnel to achieve it.
That's great. And I think that engaged part is really important, because most investors and most people that I know that are looking to place money, they want it to be something they're excited about.
Oh,
right? And so I'd love to hear some of your thoughts on that, around if somebody is trying to do a raise, how do they really drive up this interest so that people are interested in their deal and what they're working on?
yes, investors have to be enrolled. And I would say, when I look at the stats, the top 10% of the issuers of the deals get all the investments. I find it to be true in the venture capital space as a whole as well. It's an even lower percentage of deals that get funded at the VC level. And it's those top deals that are getting all of the interest, let alone all of the transactions. So with digital, you can do a lot of things to convey social proof and third-party validation. First and foremost, you do want to bring some capital to the round to kick things off from your first degree network. Friends, family, email audiences, social audiences, different partners who have these communities that can promote the deal. The Reg CF campaigns typically show how much is raised. If it's under $100,000 that's been produced, it could have a bit of an empty restaurant sensation. Just to throw an analogy at it, where, hey, you're in this establishment, the menu looks good, interior design, but no one else is there. It feels a little off. It could affect your experience, let alone cause doubt on whether you want to actually stay there and order. Meanwhile, there may be a place across the street with a line around the block. You don't know their product. You don't know what they serve, but you're immediately interested in it. Maybe to come back another time, but it's social dynamics. And that's what's happening on these crowd sales. This crowd investment concept is built on it.
Yeah, that's really interesting. I like that, adding the scarcity piece, right? Mm-hmm. Because I think that's what most people are really looking for. They're looking for something that's interesting, but is also going to get them a return on their investment.
Yes.
So from a CFO perspective, I see a lot of founders who underestimate how much strategy and preparation goes into a lot of these capital decisions. From your side, what do founders really underestimate most about doing the marketing side of the raise?
How much momentum they need to point to and where, as well as how much marketing budget is required with conservative projections. There's always outliers, of course. So more of what investors are looking for is that social proof, that third-party validation, the manufacturing of that, having a headline-worthy announcement on a weekly basis. This is a big deal. If your campaign appears to be stagnant, you're counting on the investor to just move forward based on their own perspective, and they're busy people. You need to show them, hey, I just spoke at this big conference last week. We wanted to announce today. We just put out this big partnership. You may have seen this podcast I was on 2 weeks ago highlighting some of these key points. Here's a team member bio. Look at all the exits they've had in the past. This is, you don't want to say it this way, but this is a safe bet, right? You want that feeling to be present. You want it to be in an industry that they're excited about, or speaking about that industry that reflects current events and different headlines and shows the relevancy and why they should be placing funds, why they should be adding this to their portfolio today. So outreach to publishers, to podcasters, to conferences, to partners, building a content calendar, talking about what's going to be announced when and where throughout the course of the campaign. I would take these tactics to offline raises as well. And then the marketing budget. I'm an agency. This isn't to self-promote me. Let's take agency out of the equation. You're going to need to buy that traffic, whether that's from Facebook or from Google, from financial publishers, some of them email newsletters where the audience is very responsive. Some of them pick issuers to feature and charge investors, and those investors then hop onto that deal flow. I mean, that's why they're subscribing. So where are you going to be purchasing this traffic from? It could be a crawl, walk, run type of scenario of, hey, we're at these testing stages. We're going to optimize. It's now working. We're going to look for opportunities to scale from here. Test, optimize, scale is our philosophy. It's something I say a lot. Really understanding, hey, this is what our marketing budget looks like to begin, and for at least 3 months, because it could take a while to really manage it to a point of effectiveness, any one of these channels. And this is how it's going to scale from there. There's some numbers used in the space. For Reg CF, Regulation 8 Plus campaign, historically it's 10%. If you're spending 10% on marketing and hit your full goal, that's looked at as a very strong marketing campaign. I've had significantly stronger results, higher type results. I would say don't shoot for that. Be pleasantly surprised when you hit it. We're generally recommending groups to scale their advertising spends once they hit about X return on advertising spend. The tracking could be a little blurry. You could look at it as marketing efficiency ratio, how much is being spent, how much is being raised, as those are the concrete numbers. There are some different consultants in the space that are now saying 3X. Now, given some of them are working on Regulation A Plus campaigns where there's 30 million, 50 million, 60, 75 million being raised. So on a $75 million deal, if you're spending 25 million on advertising, there's still 50 million afterwards. The valuation is often, I don't want to say more favorable for issuers, but different than what some of the negotiations would look like offline with the VC. All the investors are working on the same terms. So founders have shared with me the valuation allows them to move forward on this and have it all make sense. I would also tell you, you can buy traffic at cheaper levels with the right strategic buying, and that same campaign would have a 10X possible and available. But just to show different perspectives, that 3 to 10X range is what's looked at. Those Reg D campaigns, they're a little more hit or miss, but the average investment is much higher. I mentioned $100, $500 is minimum investment on Reg CF and or Regulation A Plus, sometimes $1,000 on Regulation A Plus. Reg D, $25K, $50K, far more common range as a minimum to accredited investors for Reg D. $100K would be the second place there outside of that range as the most common minimum. I've worked on real estate deals where it's $500K as the minimum. On $100K, I'd be anticipating about $260,000, $280,000 as the average investment. $50K, about $125,000. It may be a $2,500 acquisition cost, $5,000 acquisition cost more for an investor there. But as you can see, the return is exponentially higher. Bit more hit or miss. There's some Reg Ds that don't produce, capital, and you want to market at the right levels to scale up so that's comfortable yet meaningful enough towards the goal. But those are some of the contrasts.
That's interesting. And you talked a lot about you're really marketing to the right people. So especially accredited investors, they don't really want to feel like they're marketed to. So how do you earn their attention without turning them off and being too salesy with the marketing?
So for an accredited investor, a lot of these deals have an offline conversation. We're running Reg D campaigns right now where the transaction occurs on the offering page and investments come in without that offline discussion. But I could tell you the average investment is lower. Many of the Reg D marketing campaigns use advertising and outreach towards a lead form to schedule a call with the CEO, with the team, with their investor relations partner who conducts the calls at times, but to build that rapport, have a real relationship, establish trust. And we'll see the same investor, let's take it back to Reg CF and Regulation A Plus, but still accredited, come in at a much larger level when that occurs. For Reg D, I would say the same thing. Someone who may gravitate towards the minimum, even though it's higher for Reg D, would feel much more comfortable, much more excited about putting more chips on the table and a larger transaction, a larger investment from there. So I'd emphasize that word relationship.
I think that's really smart because people still want to do business with people and people they like, know, and trust. So for investors and for people who are looking to go this method of raising capital, how do they decide between doing a JV or private investors, Reg D, crowdfunding? There's so many choices out there. How should they really think about it to choose the right path?
Well, I have to say I'm answering from the marketing side of the table here. The finance,
that's what we want to hear.
Legal, everyone's going to have a different answer here. Many clients come to us when they've tried some other routes. It hasn't been successful for them. And now they're looking to take it to the crowd, especially if they have a large customer base. And that friends and family, if you're not asking them for $25,000, $50,000 amounts, they may invest just to support. And if you have 100 people who put in an average of $1,000 each, some of them less, some of them more, that's $100,000. It also speaks very loudly. You're able to put into the advertising messaging, any type of content messaging, over 100 investors. I think that's a powerful statement. So as far as, choosing, hey, am I going to VCs or angels? I would say these filings still allow for that. And larger investors, individual and group, can still participate in these rounds. And the more traction you're able to show, the more appealing your deal looks. You surpass a few 100,000, you surpass $1 million, a few million, you're outpacing a lot of the other issuers in the space. And the top deals get all the investments, as I mentioned. On a Regulation A Plus campaign, maybe you're passing 5 million, 10 million in path to 50. If you have some of these larger investments taking place there and in this round, you can then market and continue to get it out to different publishers who could talk about you, different audiences through advertising and outreach, and show a lot more momentum and traction, and with the terms that you've set for everyone to come in at. I have clients that will raise offline in between these crowdfunding rounds, and they'll be able to secure much stronger valuations by referencing their success in crowdfunding and stating, hey, if we're not able to do it at these levels, I'll just take it back to the crowd. They've moved forward at these levels, and the next round will be higher. So I can make that available to you when we're there, or we could do it at this level today, and they'll be able to get the terms they want accordingly. Others will then relaunch and then see them still invest, maybe at different levels, but in that round. So I think it gives a lot more control, a lot more ability, where you can say, hey, I'm going to bring these investors there. I don't have to wait on the responses from a few of these VCs and angels that we're going after. That being said, this is an approach that I hear very positive notes from CEOs around. If you are able to close a deal with one investor, particularly a strategic investor, at the terms you're looking for, that's probably the best route for you. I just find very few CEOs are able to have that available to them. And this does not limit the conversations you're having offline.
I see a lot of the same thing. Everybody would like to have one person who invests in all of their deals, but for most businesses out there, that's just not realistic.
Mm-hmm.
And you brought up something else that I think is a really good point. And this is how I work with founders on figuring out which path they want to go. It's how much of your business and how much of the control of your business are you really giving away, right? Because I don't want to see small business owners going for, small amounts of capital that gives away a lot of control or a lot of their future potential, especially if they're growing. And I know that's a big trap out there. So what mistakes do you see people making when they get kind of desperate for capital?
Well, for the marketing we do, it's more conversations I've had with founders where they've shared with me, whether it's past scenarios or current discussions that they're in, where investors wanted too much control, too much equity, terms that were just not attractive to them. And I've had clients that have gone down that road before, and it sounded like a burden of like, oh, we have this investor and we need to do this. They're actually the first money out. They're this, they're that. So having to take deals that they thought they were limited to before exploring these paths. Not to say every, company should do one of these. Every company that is should be marketing, but there are, a lot of considerations towards it. I'm friends with a lot of VCs. We work with different funds and investment groups. It's not to knock what they're doing whatsoever. But to the nature of your question, I think they didn't take into account the long-term nature of their company and the road to the liquidity events that they're shooting for, the exit strategy, and what's really going to matter along the way, what's at stake if they don't hit each milestone along the way. I've had groups say, hey, I should have done this years ago. I thought it had to be this one way. I was putting too much effort into my Reg D instead of having everything go through the Reg CF and show more raise there. And I had these marginally performing Reg CFs, and it was meanwhile doing better on the Reg D, but I was waiting on people for a long time. Now that I'm doing Reg CF, I'm able to raise a lot more. So whatever the route is, being able to have that end vision in mind, the risks, what could get it done sooner, or at least have some momentum sooner, and testing that out in a safe way.
I like that. And as you're talking, due diligence is something that always comes up. As you all are looking to do marketing for some of these investments, what are some due diligence that you all do before you start to market to other investors, or that other companies should do before they list?
Yeah. Well, I could tell you the filing process could take a while, and that could be the primary focus for a CEO, a CFO, a team that is looking to launch one of these raises. And marketing can unfortunately be an afterthought. So many of the issuers are already live by the time we're working with them. And it's more of a streamline of the advertising launch, a few weeks to get the content marketing program and outreach set up. What I recommend is a marketing strategy, a marketing plan for the raise. I would encourage at least 2 weeks, really 4 weeks, a full month to put this together. There's a model I've built, a system called the 8-point plan. When we're doing it over the course of a month, it's 2 sections a week, starting with the industry overview and the competitor marketing audit. You want to know what other deals are going to come across the desk of the prospective investors you're going after. If they're marketing digitally, you can see their advertisements. You can go on the Facebook ads library, go on to various Google platforms to see what Google ads they're running. You can see what publishers are talking about them, what they're saying on their social media accounts. You can sign up for their email, receive their drip systems, sign up for their webinars, see what conferences they're speaking at, what partnerships they're announcing, what publishers they're promoting with. Success leaves clues. And again, your target audience is going to be seeing this stuff. So although that may sound laborsome, I would tell you it's the most important part of the strategy. You have to understand the conversation that's happening today with the other groups in your space, the other groups that are raising that would target the same audiences and that end individual. From there, week 2, you map out the audiences you want to go after, plural audiences. You want to know where they go online, what motivates them. I want to know what they do on the weekends. The more you could personify them, the better. Then the marketing channels, you can see this goes in sequence. So now that you know the individuals, where can you find them online? What are the touch points? What you can do on those channels, both organically with content and paid with advertising. The following week, you get into creative and projections. Creative, the visuals, the messaging that are going to go into your advertisements, into your content. You're going to build out the assets, followed by the partnerships, a perspective map of individuals who manage an audience of your targets. Perspective map, who you can go after, along with the messaging sequence, so that you could build some of these relationships. It's how I've seen things go the quickest. And then finally, the last week, projections and activation. Projections, the only way to measure is with numbers. You don't want to look at a channel and say, is it working or not working, as much as know the actual mathematics behind it. For advertising, it's impressions, clicks, and conversions and associated metrics. How many times an ad's been seen, how much traffic is driving to an offering page, and how many investments, how many conversions you're getting out of it. On a Reg D campaign, there's likely a mid-funnel conversion for leads and then a closing rate of the leads. But you can see where performance is falling off for any of these channels if you have that mapped out and look to manage, you look to optimize at that stage of the algorithm. And it gives you a good idea of what you're going to need to spend and what you're going to need to do to really see this campaign hit its goals. The activation section is more or less an executive summary. You want to summarize it into a page, 2 pages. The real value of a plan is the process, the questions you're asking yourself along the way, the thinking. The plan itself is just a document. You want to be able to convey what's in that document very briefly. So if you're working with a marketing partner, you're giving this to your marketing team or hiring a consultant to do this, you're sharing it with your CFO or with your portal or broker dealer that you're doing this raise with. You have a very clear guideline. You're able to get them to understand it. If more groups did that strategy, the success rates would look far different.
I love it. I love having the plan and being able to execute it, right? So how important is the CEO or the person who's running the deal to all of this as well?
People invest in people, like you said. People want to, communicate with people. I would say the most proactive CEOs, founders have the most successful campaigns. There are exceptions to that, but it's a good thing to be able to add pictures, videos, casual videos, sometimes even, selfie videos at that of the founders speaking and giving updates and thanking the investors who have come in and talking about the road ahead and sharing the excitement. I believe that the energy around that transfers, at least to an extent, and shows, who they're investing in. It's great if the CEO has prior success to point at. Hey, grew this company to this level, in the past grew those companies, exited those. It could be fulfilled with team member bios, but having the CEO talk about how lucky we are to have these individuals on the team and what it's meant for our growth thus far and where we're going from here. Depending on the filing, you have to be careful around forward-looking statements. You may have to talk more about the industry, and then you can be far more detailed on how this space is growing so much, and we're excited to be a part of it for these reasons. This is where it's projected to be next year and a few years down the line. Even hearing me talk about it, you can see it's much different than just reading it on paper. So I talked about manufacturing content, getting that CEO featured on podcasts, speaking at conferences, getting write-ups in press releases. The more you're able to point to there, the better.
I like that, because I think as a business owner, you should be excited about what you're working on. It's not just about the money. It's not just about, money's nice. I don't knock that at all, but you should be excited about what you're working on. It should be somewhat meaningful. And I do think that energy really translates.
It's a big trend right now on social media with, I hate to name, we'll say fast food restaurants and their CEOs and how much they enjoy or do not enjoy their product. And so there's all these memes of, I want to see the CEO of IKEA put together, a shelving case. And I want to see the CEO of one of the airlines sit in the middle of one of their seats on a long haul flight. It's because that actually does resonate with people. That excitement, that energy, learning about why they do it. It can really not only shape perspective, but the narrative that a prospective investor is telling themselves when they're looking at a deal.
Absolutely. One of the things that I love about the crowdfunding and some of these other models is there are a lot of regulations in place. I'm not holistically not a huge fan of that, but I think it offers a lot more protection. Based on what you see from the marketing side, do you find that to hold true, or do you think how should people who are looking to invest look at it as well?
Like you, I applaud the investor protections and really how it should be safe on all sides of the table. This democratizes access for issuers to reach investors and for investors to participate in early stage, growth stage deals, private companies in most cases. So that's exciting, but they need to make sure they're getting truthful messaging. There are different laws in place for what we could say, what we cannot say in advertising. There are different disclaimers that need to be stated for different pages and content out there as well too. Again, what you could talk about, what you can't in terms of forward-looking statements. So those are in place. I think one question mark is around valuations. I would tell you a lot of the retail investors have more enthusiasm around the type of deal, the industry, the founder, some of the accolades they've received, than the sheer numbers behind it. So as an investor, you'd want to have the right strategy. How many deals are you going to have in your portfolio, high risk, high return, what percentage of your portfolio is that? Should be low. But if you're being aggressive or conservative in your age and your assets and all the different things that you'd want to sit with a financial manager around and be able to know where this fits into your strategy versus just invest in something. Given some of the deals, it's small investments that people are putting in, but still I am with you where those are, hard-earned funds. Every dollar counts. So I feel good about the process the SEC and FINRA have in place to prevent bad actors from getting involved in this space, from making sure deals are compliant and following different audits. And I think that has created a safer environment But all these deals have risk. Not every company is going to succeed. So I think it's assessing your risk and your strategy to make sure it fits into what you want to do, either as the issuer or the investor. And of course, being truthful in communications.
I couldn't agree more. I think it should be a win-win all around, because what we're trying to do is really give opportunities for people that they wouldn't have had otherwise, right? So you would not
Exactly.
have a chance to invest in some of these businesses if they didn't do crowdfunding, if they weren't attracting, investors, whether they're accredited or not. These people wouldn't have those opportunities. They'd be stuck in things in the stock market, which may or may not generate a similar return. I have my own take on that. Not a huge fan. I like things I can see, touch, and feel.
Sure.
Doesn't mean there's not a place for it. You just got to figure out how it fits in your portfolio and at what percentage rate. Well, this conversation has been awesome. So if we have founders who are listening today that might need capital in the next year, but aren't really quite ready yet, what should they start doing now so that they aren't scrambling later?
Well, I've mentioned the word plan a lot. Business plan, marketing plan. You do want to have a close connection to what tomorrow looks like. Next month, later this year, next year, 5 years, 10 years. Why not? If we were driving cross country, we'd want to have a roadmap.
Yep.
I'm old school. I'd probably, print one out or have some type of guide. We may change up the stops along the way, but we have a direction and where we're going. And we may want to prepare for each stop along the way before we get there. Hey, tomorrow we're going to be in Nashville. We're going to be in Miami. We're going to be in Dallas. This is what we want to do, and start planning for that. So if this is a road that you're looking to go down along your cross-country drive to your exit, speak to equity crowdfunding portals. Speak to lawyers, accountants, speak to marketing agencies, get their expertise. Hey, you've worked on many of these campaigns. You've worked on a lot of capital raises. Do you think this is right for us? What would we need to do for it to be successful? Not just to get one live, but to actually hit the goals. Start feeling out whether that looks attractive to you or not, and building a whole plan. I would tell you marketing is a major part of this, at least to the success of it. So you'd want to speak to different founders and or marketers who have experience here and put together that strategy. You don't have to do it, and then determine when and if it's the right choice for you from there. And you could explore that against other fundraising paths. You could look at how this could amplify some of those discussions, and if there's a combination approach that would work for you versus just one or the other. But I know I'm always open to a warm marketing discussion and talk about capital raising. I look at it as a duty for how many deals I've worked on. I know many other service providers feel the same. I want to see a higher success rate industry-wide. I envision this to be the primary approach towards capital formation a few years down the line here. And we live online. Why wouldn't we be seeking out more investments online? It is something that you should have an education in, if nothing else.
Absolutely. I love it. Today has been a great conversation. Before we wrap up, I'd love to know, what is one secret that you wish you would have known starting out as an entrepreneur?
One secret as an entrepreneur. Well, I guess I can't say enough about strategic partnerships and referral partnerships and what that can mean towards the growth of a business. This strategic partnership could be around talent. It's all about the people, and what you're building could be around the tools, especially in this day and age, and how that can accelerate things. Depending on the type of business, customers, clients being referred from these partners, I would start building those relationships now, stack them up early, look at quality, look at a real rapport being built. Don't rush it towards transactions and maybe years before someone refers something over. But if you have a real relationship, a real alliance, it can get you way past your projections. I would look at it as a numbers game on top of that. Again, not to discount the quality. strength of the relationship, but don't count on one partner. Look to, build 100 more. But strategic partnerships have been instrumental to our success, as well as the success of my competitors. And, you really want to begin that early. Don't wait to unveil to the world. You could be careful about what you share, of course, but start the seeding of those relationships, those conversations, those partnerships early.
That's some great advice. So before we wrap up, if our listeners want to connect with you and learn more about what you're working on, what's the best way for them to reach out?
Sure. I'm very accessible on LinkedIn. Jason Fishman, Digital Niche Agency, DNA, here in Marina Del Rey, Los Angeles, California. You could go to digitalnicheagency.com, reach out to us from there, learn more. I also point to our YouTube channel, youtube.com/@digitalnicheagency, which you could access from LinkedIn or our site. But I put out a monthly webinar, a weekly podcast, guest appearances, conference appearances, a lot of educational content there.
Well, thank you so much. And thank you to everybody for listening to C-Suite Secrets. If you've found today's conversation as valuable as I have, be sure to hit that like and follow button and share with somebody else who's building a business. If you want more tips on how to grow your business between episodes, you can check us out on Facebook at C-Suite Insiders or on Instagram at Heather Parsons Official. Until next time, keep growing, and remember, you don't have to do this alone.